Welcome to Pro News Flash. Oil finds no silver lining. Let's dive into the latest developments. Oil has returned to the levels seen before the armed conflict in the Middle East much sooner than expected. Brent's fall of almost 40% from its March highs is not solely due to the fact that more barrels are coming from the Persian Gulf. The market has adapted to the most far-reaching crisis in the history of the oil market. As a result, traffic through the Strait of Hormuz need not return to previous levels to restore balance. A return to 65% or 11 to 12 million barrels per day will be sufficient. Morgan Stanley put forward this assumption and lowered its forecast for the average price of Brent to $75 per barrel for the third and fourth quarters. That is $15 and $5 lower than its previous estimate. According to the bank, while more barrels are flowing through the main oil artery, the bear's previous trump cards remain in play. These include record growth in U.S. exports and a decline in Chinese energy imports. The Gulf states' search for alternative routes has made it possible to partially meet demand from Europe and Asia for the next couple of months. These continents do not require any more oil. The Iranian output could also surge to 3.3 million barrels per day by the end of the year, following the lifting of sanctions. Combined with the gradual recovery in production in the region, this creates a distinctly bearish backdrop for Brent. There's no doubt that the market will stabilize over the coming weeks. It will need to replenish global stocks, which have been considerably depleted, and meet growing demand from Europe and Asia. Oil prices could even rise if the conflict in the Middle East escalates. If the conflict does not escalate further, the long-term outlook for Brent looks rather bleak. According to estimates from the International Energy Agency, global crude oil supply will fall by 3.9 million barrels per day in 2026. Supply is expected to increase by 8 million to 110.3 million barrels per day in 2027. Demand will recover at a much more modest pace. And next year, the oil market risks facing a surplus of 5 million barrels per day. Thus, barring an escalation of the geopolitical conflict in the Middle East, the downward trend in Brent is likely to persist. Stay tuned to Pro News for further updates on developments in the financial markets. Like, share, and subscribe.